In the frantic, late-stage market frenzy of the early 2020s, a new, fast-moving vehicle emerged to circumvent the traditional, arduous path to the public markets. It was called the Special Purpose Acquisition Company, SPAC, or simply the Blank Check Company. For decades, the initial public offering, IPO, was the gold standard, requiring rigorous regulatory scrutiny and long roadshows. The SPAC offered a tantalizing shortcut, a vehicle that raised capital from public investors solely to acquire a private company, merging it onto the stock market with minimal regulatory oversight and maximum speed. It was marketed as a democratic innovation, but it quickly devolved into one of the most reckless speculative blunders of the era, vaporizing billions in retail investor capital. The SPAC bubble was fueled by two powerful engines: zero interest rates and celebrity endorsement. The era of free money meant that investors, desperate for high returns, poured cash into any vehicle promising rapid growth, regardless of underlying fundamentals. Simultaneously, SPAC sponsors, often successful financiers, former politicians, or A-list celebrities, lent their names to the blank checks. This created an illusion of legitimacy and exclusivity, convincing retail investors that they were getting an early, privileged look at the next big tech disruptor. The combination of easy money and celebrity marketing proved irresistible, transforming a niche financial tool into a market phenomenon. The fundamental structure of the SPAC was designed to benefit the sponsor first, and the retail investor last. The sponsor typically received a generous 20% share of the pre-merger entity for minimal upfront cost, a massive incentive regardless of whether the final merged company succeeded or failed. This promote, as it was known, ensured that sponsors had a powerful incentive to rush through any deal, no matter how speculative, just to monetize their free shares. This inherent misaligned incentive was the deep-rooted flaw in the SPAC model, turning the process into a rush to acquire, rather than a thoughtful search for value. The speed of the SPAC was its most damaging feature. Traditional IPOs rely on underwriters and intensive due diligence, processes that often force a private company to prove consistent earnings and viable business models. SPAC mergers, conversely, allowed private companies, many of them pre-revenue, highly speculative, and operating on optimistic projections, to bypass this scrutiny. The rush to find a target company and complete the merger within a short 2-year timeframe meant that many deals were rushed, poorly valued, and based on aggressive, often unrealistic, forward-looking statements that would never be tolerated in a traditional IPO filing. The market quickly became saturated. SPACs, once rare, proliferated, with hundreds launching in 2020 and 2021, collectively raising over $160 billion in capital. This glut of blank checks created intense pressure to merge quickly, often forcing sponsors to bid up the prices of dubious target companies. The promise was that this shortcut would democratize finance. The reality was that it created a high-risk, high-fee vehicle designed to extract maximum value for the sponsors while leaving retail investors holding the bag of overvalued, unproven companies. The stage was set for the inevitable, brutal collapse, as these paper valuations met the cold reality of public market earnings requirements. The SPAC process promised the public market access to the next generation of disruptive companies, but what it delivered was often highly leveraged fantasy. The moment these SPACs successfully merged, known as the de-SPAC transaction, the private companies, now public entities, were forced to shed the aggressive sales projections used to justify their valuation and face the rigorous scrutiny of public market accounting. This transition revealed the core blunder of the entire bubble, an astonishing gap between the hype and the harsh reality of their balance sheets. The destruction of shareholder value that followed was swift, brutal, and historic. A prime example of this hubris was the electric vehicle (EV) sector, which became the prime hunting ground for SPAC sponsors seeking explosive growth narratives. Companies with little to no revenue, often still developing prototypes, were valued instantly in the billions. Nikola Corporation stands out as a canonical blunder, a company that merged via SPAC and was valued at over $25 billion at its peak, despite producing no commercial vehicles. Whistleblower reports and regulatory filings later revealed that much of the company's technological claims were exaggerated or fabricated, including a famous promotional video showing a truck driving that was actually rolling downhill. The subsequent regulatory action and the massive plunge in stock price became a symbol of the SPAC ecosystem's lack of due diligence and focus on pure speculation. Beyond EVs, SPACs aggressively targeted nascent technology sectors like space exploration, financial technology, fintech, and even digital media. In nearly all cases, the pattern was the same. The target company was projected to achieve exponential revenue growth that was laughably detached from market conditions. The reason for this aggressive forecasting lay in the rules of SPAC mergers. Unlike traditional IPOs, SPACs were permitted to use highly optimistic, forward-looking statements in their presentations, which were shielded from the liability typically applied to official regulatory filings. This loophole became the mechanism for legal deception. The performance of the vast majority of de-spaced companies has been catastrophic. Data confirms that the majority of SPACs that merged between 2020 and 2022 are now trading at a fraction of their initial public offering price, with many having lost 90% or more of their value. This massive, systemic wealth destruction disproportionately impacted retail investors, the very people SPACs claim to democratize finance for, who bought into the hype generated by celebrity-endorsed narratives and unrealistic projections. This was a clear wealth transfer mechanism. Sponsors and institutional investors cashed out early on their cheap shares, while retail investors bore the losses. One of the most insidious blunders involved the warrants, options to buy shares at a fixed price, that were often included in SPAC units. These warrants further diluted the retail shareholders after the merger, adding insult to injury. Furthermore, the massive amount of money sponsors spent on fees, legal costs, and banking services, all paid out of the cash raised by the SPAC, meant that the target company often received significantly less capital than advertised. This high-fee structure and dilution led to a common outcome. The merged company was left with less cash, more debt, and a valuation that was immediately indefensible, ensuring its swift descent into penny stock territory or eventual bankruptcy. The SPAC's bubble proved that in finance, a shortcut is rarely a path to sustainable value, but often a detour to a massive, expensive failure. As the SPAC bubble spectacularly deflated throughout 2022 and 2023, leaving behind a trail of bankruptcies and near-zero stock prices, the focus shifted from the companies themselves to the regulatory environment that had allowed the frenzy to occur. The primary regulatory blunder was one of sluggish response. The U.S. Securities and Exchange Commission, SEC, the watchdog of American financial markets, was slow to address the structural flaws of the SPAC process, only moving to propose substantive new rules after the vast majority of the damage had already been done and billions of dollars in retail capital had been destroyed. The SEC's belated intervention targeted the very loopholes that made the SPAC a shortcut: the ability to use overly aggressive financial projections and the lack of liability for underwriters and sponsors. New proposed rules aim to treat the de-SPAC transaction more like a traditional IPO, imposing greater scrutiny on forward-looking statements and increasing the liability for all parties involved. However, by the time these rules were debated, the market had already self-corrected, or rather self-destructed, rendering the need for SPACs almost completely irrelevant. This lag demonstrated a profound failure of oversight, allowing a flawed financial instrument to flourish during a period of peak speculation. The scandal also focused intensely on the role of celebrity and political endorsement. A key feature of the SPAC boom was the attachment of high-profile names to the blank check entities, ranging from former House Speaker Paul Ryan and tennis champion Serena Williams to rapper Jay-Z. These individuals, often lacking deep financial or technical expertise, lent their personal brands to raise capital from retail investors. Their involvement leveraged trust and familiarity, suggesting an inherent level of safety or high-quality deal flow that simply did not exist. When the underlying companies failed, these celebrity sponsors faced severe public backlash and regulatory scrutiny. The SEC issued warnings and took action against several high-profile sponsors, emphasizing that celebrity endorsement does not mitigate the risk of highly speculative investments. This aspect of the blunder was particularly egregious because it targeted the least sophisticated investors. The use of famous faces effectively packaged complex, high-risk financial instruments as consumer products, blurring the line between informed investment and celebrity marketing, ultimately eroding public trust in the integrity of the market. The financial collapse also triggered a wave of investor lawsuits against sponsors, boards, and the target companies themselves. These lawsuits alleged misleading projections and breaches of fiduciary duty, arguing that the mergers were rushed to benefit the sponsors' 20% stake, not the public shareholders. This legal reckoning confirmed the initial structural flaw. The misalignment of incentives was not a side effect, but the core design principle of the SPAC. When sponsors could guarantee their massive profits regardless of the merged company's long-term performance, the motivation for genuine due diligence vanished. Ultimately, the market rendered the final verdict. As interest rates began to rise and speculative capital dried up, the viability of the SPAC model evaporated. Hundreds of SPACs that had successfully raised capital but failed to find a target within the 2-year deadline were forced to liquidate and return the capital to investors. While investors theoretically received their principal back, minus fees, they lost the opportunity cost of having their capital tied up for 2 years and incurred the massive inflationary hit that occurred during that time. The SPAC bubble ended not with a bang, but with a quiet, expensive whimper of liquidations, confirming the entire structure was a vehicle built for one specific, speculative moment that had swiftly passed. The final result was a multi-billion-dollar blunder that left a legacy of skepticism and a clear lesson about the dangers of prioritizing speed over scrutiny in finance. The implosion of the SPAC bubble left behind a permanent and costly legacy, one defined by heightened public skepticism and the vaporizing of an estimated $160 billion in capital raised during the peak frenzy. The final, enduring blunder of the SPAC era is its role in eroding trust in the financial system. For retail investors who were promised early access to high-growth, disruptive companies, the reality was massive losses, leading to the feeling that the game was rigged to benefit only the sponsors and the institutional investors who got out early. This perception of institutional unfairness poses a long-term threat to the health of the public markets. One of the most insidious consequences was the permanent damage inflicted on the very companies that used the SPAC route to go public. Many viable, albeit early-stage businesses were forced to enter the market at unsustainable, overinflated valuations driven by the bubble. When the bubble burst, these companies were branded as de-SPAC failures, regardless of their underlying technology or potential. This resulted in a valuation overhang that made it extremely difficult for them to raise follow-on capital, attract top talent, or compete effectively. For many, the SPAC shortcut became a path to financial asphyxiation, proving that a flawed entry into the public market can doom a company regardless of its product. The financial community, particularly investment banks that earned massive fees from the SPAC boom, faced a reputational reckoning. Banks were accused of prioritizing high immediate fees over investor protection, acting as facilitators for speculative and often poor-quality mergers. This focus on short-term profits over market stability highlights a recurring blunder in the financial sector. The willingness to aggressively market and profit from a complex, untested financial instrument until the inevitable regulatory clampdown or market collapse forces a halt. The high-fee structure of the SPAC, a massive financial drag on the merged company, is now studied as a textbook example of misaligned incentives. The ultimate lesson learned by the market is that the complexity and rigor of the traditional IPO process serves a vital, protective function. The extensive legal liability and mandatory quiet period of an IPO forces scrutiny that the SPAC process was explicitly designed to avoid. The SPAC shortcut, intended to save time and regulatory cost, proved in the long run to be the most expensive possible route for many companies and their investors. It confirmed the adage that in finance, when an opportunity seems too good, too easy, and too fast, it is often a mechanism designed to transfer wealth from the naive to the knowing. In the years since the peak, the SPAC market has mostly vanished, relegated to a footnote in the history of speculative bubbles. The blank check companies that remain are primarily those that are liquidating, returning money to investors, or desperately searching for any remaining target. The few survivors are often those that secured deals early with genuinely strong, well-valued companies. But the overwhelming majority of the over 600 SPACs launched during the frenzy have failed to deliver value, with data confirming the systemic underperformance of the de-SPAC cohort. The story of the SPAC's bubble is the definitive financial blunder of the COVID-era market. A moment where easy liquidity and speculation created a perfect storm for a structurally flawed instrument. It serves as a permanent, expensive reminder that no amount of celebrity endorsement or technical jargon can override the fundamental laws of value and financial gravity. The trillions lost in the bond market were followed by the billions vaporized in the SPAC market, collectively proving that the cost of financial exuberance when divorced from reality is always paid in full by the public. This massive transfer of wealth confirms the enduring lesson. Shortcuts in finance usually lead to the longest, most painful road. Please hit the subscribe button and thank you for exploring with us.